Good evening, friends. On behalf of My Retired Life Foundation and also on behalf of the SIS School of Learning and Leadership, we have great pleasure in welcoming all of you to this particular session today. This is very interesting and very important for many of us, particularly the elderly citizens and even for the teaching community. That some of us are investing in the stock market, but some of us are not. And some of us would like to invest in the stock market, but are not very clear about the basics of the stock marketing. So they do not know how to proceed, they do not know how to select the stocks, and so on and so forth. So we thought that we would keep a basic introductory session on that, and we are thankful to Prakash Faraj, our member, that has been kind to introduce such an eminent personality for this particular topic. So today we have an hour session on the important topic of the basics of the stock marketing, and to talk on this particular topic we have very esteemed speaker, Dr. Nirakar Pradhan. Dr. Nirakar Pradhan is a PhD holder from Utkal University in the area of the business administration. But he also is an expert in the area of the enterprise risk management. He holds many degrees that include CFA, FRM, and PRM, which are considered to be the master degrees and which are considered to be the very useful and the relevant degrees for the financial market. He has led the enterprise risk management departments of two of the leading conglomerates of the world into different parts of the world, if you put in that way, in the State Bank of India, in this part of the country, and also what is called a Generali Group, which is essentially an enterprise risk management company in the European market. So both in the Asian market and the European market, he has led this enterprise risk management. He is a very esteemed person in the area of the financial market. He is CEO of CEO of what do you call uh, risk management investment company, let me put it that way, which is called the Fincosori Nivesh Private Limited. But he is also the CEO of a very famous and very well-known what is called Risk Management Association. So we are extremely privileged to have you with us, and the floor is open to Sir Dr. Pradhan for enlightening all of us on the basics of the stock marketing. Dr. Pradhan, the floor.
Very good evening, everybody. Thank you, Dr. Sengupta, for kind words. Honorable distinguished members this evening, and thanks Mr. Prakash Faraj, who has been my senior colleague in State Bank of India. He has been my friend, philosopher, and guide. And with me is Aman, my colleague from Fincosori Nivesh Private Limited. At the beginning, let me tell you, we are SEBI registered investment advisor, heavily regulated. And that's why I want to put a small disclaimer. Registration granted by SEBI, membership of BSL and etc., they don't guarantee any future performance. And stock market is very volatile. You have to think and examine yourself before making any investment in stock market. So time is 1 hour. What I want to do is about half an hour. We have about 15 slides. Aman and I, we want to take you through very, very basics about the stock market, how to approach the stock market. Maybe some of you have more knowledge, more skill, more experience, more money you have made from already. And please let us interact and ask any questions that during presentation. Next slide, Aman. So, first of all, I want to congratulate Dr. Sengupta and all your members. Why? Because I am very lucky to be here. I consider today, this evening, this 1 hour that we spend together, in future, when we look back, maybe this is a game-changing moment. Why I say so, certainly we'll see. This is a brief agenda of our presentation. It is India's decade. How do we do asset allocation? Stocks, what are the risk return? How do you go about stock selection? Opening of a demat account and execution of transactions. Mutual fund, how do you invest? something about behavioral finance, do's and don'ts. A lot of concept, but we'll try to just toss the concept. If our interest, we'll have question answer. Of course, Aman and I, we are available to you after the event also. We'll share our contact numbers. Next slide, Aman. When I said it's a game-changing moment, I want to take you back 5 years ago, 2020, when we had a COVID. Whole of 2020 and part of 2021, most part of the world were closed, lockdown. You cannot travel, you cannot do anything. And from there, India, probably one of the countries who recovered fastest. 2021 December, we are already there, almost normal operation. Depending on other countries, they have taken little more time. This chart that you see, it was released couple of days ago by IMF, International Monetary Fund. What you see is World Economic Outlook growth projections. So global economy, in the middle is advanced economy, that is rich countries, and to the right is emerging market and developing economy like countries like India and still poorer countries, right? Going to the left side, we say 2023, 3.2% growth. Last year, world GDP grew 3.2. Next year, that is 2024, 3.2. Next year, 2025, also 3.2. Ladies and gentlemen, don't you think it is strange? Such a huge world, 3 years, it seems, no? It is not true, right? How can such a huge world can be growth rate be same, right? But still more strange information I want to share with you. Before COVID, you go back, world GDP growth was higher than 3.2. It was around 3.5, 3.6. What does it show? Even after 3 to 4 years, world GDP is lagging pre-COVID growth rate. Come to the middle one, rich countries, USA, UK, Europe. What is their growth rate? Pre-COVID, it was 2.2. Last year, 1.6. Means USA or UK or Germany, they are still having lower growth even after 3 4 years of COVID. Earlier it was 2.2, now last year 1.6, this year 1.7, next year 1.8. This is what I want to say. That is very strange but true. The growth next 2 years also, they will not match pre-COVID growth rate. Come to the right, India, China, other emerging economy. Before COVID, it was 4.5 emerging market, developing economy, 4.5%. And last year, 4.3, so lower than pro-COVID, pre-COVID. Next year, it will be 4.2, lower than this year, again 4.2. Next 2 3 years also, even poor countries, developed countries will grow less than what you used to grow before COVID. This is happening because number of factors which you already know. High inflation, those who are in UK, Germany, Europe, and USA, I think you know. You are probably the worst inflation last couple of years you are seeing, right? High inflation. Because of high inflation, interest rate is now 5 quarter to 5.5% in USA, high interest rate. And because of that low growth, and of course, last but not the least, geopolitical uncertainty. War, USSR, Ukraine started a couple of years ago. Now, this year, we have West Asia, Israel and Palestine. Lot of uncertainty. Next slide. This is very bad picture globally, but I said we are blessed to be in India. Look at the GDP growth chart. Before COVID, you go back 10 years before COVID, India growth rate was between 6 to 7, average was 6.5. Ladies and gentlemen, I am so happy to share with you, after COVID, last 3 years, we are going 7% plus. Last year, expected to be around 7 point, is over 7%. Mostly they are saying it will be 7.3%. Previous year, more than 7%. Previous year, I think it was 9%. So 7% plus. But this is the beginning. The way government has acted, structural reforms, financialization of our assets. That means more money. Earlier, it was parked in banks. Now, some money is going to capital market. Capital market is where scarce capital we provide to business. The people, those who are entrepreneurs, they raise money from either banks or capital market. Digitalization of a transaction. There is a digital revolution all around the country. The digital transaction from India is more than half of the global digital transaction as of today. And now India has emerged as the fastest growing major economy last couple of years, but going ahead next 4, 5 years or 10 years also, this trend to continue. But this is what I want to tell you in the context of stock market. If you know India got independence 1947, past 50, 60 years, our growth rate was 3 to 5%. It took 60 years for us to have first 1 trillion US dollar economy. GDP growth equivalent of 1 trillion, it took 60 years. Second trillion, it took 12 years. Third trillion, it took us 5 years. But the last 2, 3 years post-COVID, there has been that transformation speed has really gone very high. We expect India to be 10 trillion economy in next 10 years. Why it is important? Because the GDP growth is what? Wealth created by retail and wholesome player. That is corporate and retail. Whatever we combined wealth we create, that is called GDP, right? Gross domestic product. GDP is growing means somebody's wealth is increasing, right? When from today is around 4 trillion, it will go to 10 trillion next 10 years. To that extent, wealth will increase. And in case sorry.
Okay,
Sorry, there is a question for me.
No, please go ahead. Please go ahead. There was a disruption. Please go ahead, sir.
Okay. So what I want to tell you, next 10 years, GDP is going to be 3 times. Most likely, this is my personal view. If GDP is going to 3 times, stock market will be slightly higher. Let us guess it could be 4 times or 5 times. Today, you put X money in stock market. If you are taking care of a due diligence properly, your money may, I will not be surprised. After 10 years, we meet somewhere, you say that yes, you put money and your money has grown 5-fold after 10 years. Next slide, Oman. Coming to basics of financial planning or asset allocation. Earlier, before 10 years, most of our money was going to bank deposit. Today also 90% of our household savings are parked in bank deposits. Less than 10% money is flowing to stock market. 90%, not only bank deposit, of course, real estate, gold and other side, but stock market investor from India, retail investment from India is less than 10%. And when I say less than 10%, before COVID, it was only 2 to 3%. So last 3 years, it has almost got doubled or 3 times it has gone up because exactly what just we discussed. People see there's an opportunity in stock market. When I say asset allocation, this is a technical term. It is nothing but investing your money. Could be bank deposit, could be gold, could be real estate, could be bonds, or last but not the least, stocks. And stock, among all the asset classes, considering risk and return, stock is the best. Risk-adjusted return. This is the only asset class where long term you beat inflation, you have a real return. And that's why we want you to look at investing some part of your savings in stocks. And that is a thumb rule. How much percentage of money you should invest in stock? They say thumb rule is equity allocation is 100 minus your age. You are 60-year-old, 40% should be in stocks, but there are many other factors you have to consider like risk appetite and your own confidence level. One thing I want to warn you, don't invest in stocks without fully understanding what you are doing. Next slide, Aman. Coming to risk and return, I don't want to go into jargons, but I want to share with you. This is chart, 20-year chart of Nifty, and CAGR return we call it. That is compound and return. Annual return last 20 years is nearly 14%, 1-4. Last 10-year return is slightly less, 12.771. Because COVID 1 year we lost, so that is also included. That's why our return has been little down, but about 13 to 14% the last past returns. Going by next 10 years, if you want me to forecast, because GDP growth has been about 1% higher after COVID. So stock market return, pre-COVID stock market return, post-COVID stock market return, difference should be 2 to 3%. So before COVID, we had about 14 to 15% annual return. Post-COVID, next 10 years, if I can personally forecast, it will be 2-3% higher. So 15 to 18%. How does it compare with the bonds or bank deposit? Bank deposit in India, I think this is one of the highest rate, 6 to 7%. But tax is 20%. Minus tax, real return in your hand is 5 to 6%. Compared to that, stock market return is almost 3x. Bank deposit or interest on bonds is tax 20%. But here, tax on stocks, rather there is favorable tax treatment. More than 1 year holding stocks is called capital gains. Capital gains more than 1 year holding, you pay only 10%. So there is favorable tax treatment from return as well as tax treatment as well as a long-term growth story. I think stock that risk-adjusted return is attractive as far as India is concerned. One thing, the risk. Those who are in USA, they know, but I think everybody will be aware of what happened 2007 and 2008. We call it global financial crisis. Crisis started from our richest country, that is USA, the real estate crisis, home loan crisis. It spread whole world, and within 1 year, whole stock market globally fell. India, 2009, we lost about 50% Sensex. But next year, 2010, the stock market went up 80%. What I want to tell you, in case you are investing in stock market, think long term, think fundamental growth story. If you understand the risk, then you should have patience. When the market is down, don't sell in panic. And this is what this chart shows what exactly I am saying. If you are looking at a 1 year rolling return, this is 1980 to 2024, you will find there are 10 cases, 10 years where we have negative return. Negative return is you have a loss that during that year. But if you have same analysis for 3 year, for 5 year, 10 year, 15-year rolling return, go to 15 years, the probability of having loss is 0%, which means if you are investing in stocks and you are not selling when market falls and you hold on 15 years, not only you get year after year CAGR return of 14-15%, your money multiplies. Also, there is no loss. Next slide. Then how do we go to stock selection? There are two theoretical schools. One is technical analysis, one is fundamental analysis. Fundamental analysis is nothing but finding intrinsic value. When you go to the market, whether you are buying clothes or buying vegetable or fruits, there are many shops. You first examine, explore cost and quality, then you buy, right? Same thing. Stock market is nothing but just like buying some business. How do you find out that intrinsic value of that stock before purchasing? Because once you buy, then you are the owner of that stock. Then the fundamental analysis, you find the intrinsic value by analyzing the financials. Last 1 year financial, 5-year financial, 10-year financial. You see what is their sales, turnover, what is the profitability, find out cash flows, find out what is should be the intrinsic value of that stock today. and what is the market price. If the market price is lower than the intrinsic value, you buy. If the market price is higher than the intrinsic value, don't buy. The second one is technical analysis. This is more of trends analysis, chart analysis, which we'll cover in the next slide. Next slide, Amma. Going to fundamental analysis, investment, like you discussed, investing in stock is nothing but buying your a business. Suppose you want to be the owner of a Tata Motor. Tata Motor you cannot own because so much of capital, but you buy one share also, you are part owner of a Tata Motors. So you are basically concept-wise, fundamental analysis, you are buying a part of that business. And what is the assets? You are this is financial analysis, assets side and liability side. No, we say they should be same. So liability side is a liability plus shareholder equity. This is what you have to understand if you were making fundamental analysis. How do we do that? There are many ratios you have to understand. And end of the day, what I want to ensure, safety of my investment. Liquidity means whenever I want to sell the stock, whether I can get back my money. And third, also goal is whether I will get sustainable return, like we discussed, past return is 15%, whether I will get that 14-15% return. And what are those ratios? To quickly, I want to share my ratios. As you know, I am also one SEBI registered investment advisor. We have a portfolio. We run a portfolio. These are the 10 parameters we see. One is market cap should be more than 5,000 crores. Corporate governance and management quality should be very good. Then several other financial ratio like, average annual return should be more than 12%. CAGR revenue growth should be more than 8%. Profit above 10% and so on. We'll not get into individual technical ratio for want of time. Next slide, Oman. And the other side is the technical analysis. This is a chart. I hope you are able to see. From the chart, this is called head and shoulder pattern. What does it show? The prices was growing. The first circle is called shoulder. It still grew. And this top one is called head. And then it fell. The second circle is called another shoulder. This is just like a human being, two shoulders and one head, right? What does this chart shows? The stock price moved higher and higher, then reached a peak, then it's falling, and it shows that this declining trend will continue. What is the message? If I am an investor, I want to buy this stock, I will not buy because there's a probability of stock price going lower. This is called technical selection of the stock. Next slide. Okay, before getting into broker account, Aman, I want to complete the continuity that two links. Can you share little bit of more
Yes,
of
sir.
fundamental analysis, ratio analysis?
Okay.
These two
So
links.
thank you, sir. So these are the two examples. Basically, there are various sources where you can look for various data when you're trying to analyze a stock. But right now, I'll show you the two of the famous sources you can use. First is screener.in. So screener.in is a platform where it is more number specific platform where you can get, let's say, for example, for now I have opened Tata Motors Limited as a stock in screener.in. So here you can see what is the market cap. Like sir has shown you, we see at various numbers before we even start evaluating the stocks. We need to look for selection of in a portfolio, right? For example, first, the market cap should be greater than 5,000 crores. So here you can see the market cap and see that if you want to include the stock in a portfolio as per the parameter or not. Then you get price to earning ratio of the stock, then return on capital employed, return on equity. These are some important ratios which we use, and Skinner.in is very important, very useful website for that. You can also get long-term chart for the stock here, and there are also various, so analysts have various qualitative this thing analysis is already done on this website, and you can get it mostly for free, like pros and cons of the stock. And you can also compare to the peers here, uh, similar stocks in the industry, and then the results also can be compared for last uh, 10 years. This was one. Second is ticker tape. Now, ticker tape is basically a bit more qualitative than scanner.in. Scanner.in gives you options to and crunch the numbers yourself, whereas tickertape.in helps creates a basically a performance scorecard for you to analyze. So basically, if you see on the left side, you can see the various parameters and it will tell you how the stock is performing in those parameters, like performance, stock performance, basically the price movement. It has been good or bad for the last 12 months. So here, let's say, say the Reliance industry, performance is comparatively low, valuation is considered to be high, growth also last 12 months has been low. So these are the qualities which you can check and you can decide if you want to invest in stock. But our recommendation will be to also look into the numbers with sites like Skinner.in, or you can use moneycontrol.in. Look into the numbers yourself before relying on the analyzed uh, quality. So that was on my side.
Yeah, Aman, you can go to the next slide.
Okay. So now, after Nirakar sir has helped us with the stock selection and other allocation part of the investment, we'll go through the practical part where how we open a broker account and start investing. So first step is choosing the broker. So you should select a stabilization broker that meets your investment needs and your suitability. Various things people look into is the fee, the brokerage, the service quality, and the trading platform usability. That's just how the user interface looks to you. But the main point to choose a broker for most of the people is the brokerage, which we'll talk about in the next slide. Then the process of registering, so online registering, most of the brokers allow you to open, almost all the major brokers allow you to open your uh, uh, Demat account online. There is virtually zero physical documentation or signing required. The application form, you need to fill out an application providing your details like name, address, PAN account number, Aadhaar number, and bank details. Now, document. Two main types of identity. Please require a proof of identity and proof of address. Aadhaar card, passport, and driving license. Basically, any of these three are complied with. And then PAN card and your passport photo is required. Passport photo is now replaced with video KYC and online photo if you are doing it. KYC process. Once you have submitted all these documents, the KYC, EKYC process is basically complete. Then comes the agreement signing part. So all the brokers have a set agreement where mostly they are obligated out for certain parts of their role. So this needs to be signed from both the broker as well as the investor. Then we come to verification approval part. Once you have submitted all the documents and your bank details and bank information, basically you have registered your bank with it, then they'll go it will go for a verification, basically either through a penny drop or something like that, and your verification, your application will be approved in 24 to 48 hours. And once that is done, you will receive your demat account credentials and you can start investing. Now coming to the most important part of broker selection, which is the fees and charges. Basically. Before coming to brokerage, we'll come to transaction charges. So these, if you can see on the right, these are transaction charges you incur when you invest into stock, and this is applicable to all brokers. So this is basically government charges. So security transaction tax, STT of 0.1% of your turnover. Then transaction charges based on the exchange you are using, NSE or BSE. Then GST of is 80% on the brokerage plus the SEBI charges and the transaction charges of the exchange. SEBI charges rupees 10 per crore. So if you're investing 10 lakh rupees, it will be the SEBI charges is rupees 1. Uh, and stamp duty of 0.015% as stocks are basically it's like in getting a property in a dematerialized form. So you have to pay the stamp duty. Now coming to the broker specific charges. So we have selected four major brokers, four of the major brokers. There are many other brokers you can choose, but this is just to show you the different types of charges and the difference of the brokers. So, coming to account opening fee, so Upstocks, ICICI Direct, and HDFC Securities, they charge 0 rupees for account opening, and Zerodha charges rupees 200 for people aged above 25. But when you come to brokerage charges, it gets reversed. Zerodha basically charges nil brokerage charges for stock deliveries, and while whereas the Upstock charges 20 rupees or 2.5%, whichever is lower on equity delivery. ICICI charges 0.55% of your turnover, basically how much you have bought or sold, irrespective of, there is no ceiling or limit of that. HDFC Securities is a little complicated part, so it's minimum rupees 25 or 0.5%. This is the minimum, so, and there's a upper ceiling also, which is 2.5% of your transaction value. Basically, transaction value is your turnover, which includes both buying and selling. Coming to annual maintenance charges, this will be these are the charges plus 18% GST will be applied. So for Upstock, it is rupees 150 flat. Zerodha is 300, ICICI Direct is 700, and HDFC Securities, there are separate types of accounts. The basic account charges 0 rupees, but for the different advanced accounts, it goes to 300, and last final is 750, the highest. So basically, there are some advanced features for some of the accounts for which they charge the high. So that was all.
Hey, Aman, if you permit me, I'll take because we are little delayed by 2 minutes. Can I go through?
Sure, sir. Sure.
Okay.
Mutual
Uh,
fund, right?
Then next slide is a mutual fund. See, this is first time you are investing in stocks. Better go through some mutual fund route, because that way you gain some experience before really investing in stocks yourself. What is mutual fund? Mutual fund, they pull retail investors' money and they invest in on your behalf in stocks. There are two types of mutual funds. We call it direct plan and regular plan. What is regular plan? You go through a distributor, and direct plan, you can directly invest, or you can go through some, there are many advisors. Through them also you can invest directly. What is the difference? Direct mutual fund, return is slightly higher, because a regular fund, the distributor, some fees you have to pay. Next slide. Aman, next slide. Behavioral finance. This is maybe you don't know, or you already know. See, we all know about others' market behavior, others' behavior, but research studies have shown that fear, greed, loss aversion, status quo, overconfidence, these are various emotions within us. They impact how we decide our financial decisions. So this is a very interesting topic. Mr. Prahraj and me, actually, we have written a book during COVID. So it's interesting. So I thought I will also share with you. There is one Charlie Munger who passed away a couple of months ago. He was working with Warren Buffett. He says, when the stock market pond, when you are a duck in a pond, and if it is rising, that pond is rising due to a downpour, you start going up in the world, but you think it is you, not the pond. So basically, this is something like overconfidence. So before investing, I thought you should also look at yourself intrinsically, whether you have risk appetite, whether you are afraid of putting in the stock market, or fear, greed, loss aversion, whatever you have. There is so many softwares available, so many research articles are available to really examine your own risk appetite, your behavioral traits before investing in stocks. Next slide, Aman. Finally, this is very common sense, but still then I thought I'll put this do's and don'ts for beginner only. Is it stock market investing is informed decision making, as we discussed. Investing stock is nothing than just buying a car, buying a house. Same way you are buying a stock. Means when same due diligence you need before investing in stock. If you do that due diligence, a lot of research material freely available today in the market. You spend 1 hour, 2 hours, you will understand, you will get all your questions answered. So many videos are available thanks to COVID, okay? So informed decision making. First, you should satisfy yourself. Forget about others' tips and all that. Don't go Whatever people say, you hear, but you understand, satisfy yourself that you are okay, you are convinced to buy this stock at that price. Financial goals, invest long term, review and rebalancing. Once you invest and periodically you rebalance at least once a year, see whatever decisions you have taken, right, wrong. Add nomination, this is very important. Because what we understand, many of us, including me, we are senior citizens, that is age 60 plus. So it's better to put nomination in your demat account, and also take help of a registered qualified investment advisor. And don't fall prey to stock tips. Lot of tips are available, whether Twitter, WhatsApp, and other social sites. Don't fall to that. You may read those, but make due diligence yourself before investing. Don't deal with unauthorized brokers. So many are there in India, and they still cheat the common simple investor. Please don't do that. Don't take loans to invest in stock. As we discussed, stock is a high risk, high return game. Don't take a loan to experiment stock investing. If you are seasoned professional, yes, you can do that. Don't invest before completing due diligence independently. Thank you so much. We have exceeded a couple of minutes, but now at your disposal to take any questions. Dr. Sanigutta sir.
Yeah, I think we'll go for question answer. People can ask any question.
See, sir, may I ask some questions, sir?
Sir, can you, sir, that share screen? Can you, Mr. Aman, if you can kindly close it?
Sure, sure.
Yeah, fine.
Sir, can I ask one question?
Yeah, please go ahead, sir. Please go ahead.
See, we are senior citizens, maybe over 60. I'm over 75 years away. Only simple thing I want to know, whether we should invest in share or mutual fund, which is better for me?
Very good question. Have you ever invested in stocks earlier?
Yeah. And still I am
Because-
having some shares, old shares it is there.
Sir, if you have already invested shares, what is your experience? Good, bad, ugly? Are you happy with your investment?
With shares, not so much happy, but with mutual fund, I'm comfortable. Maybe not much more profit, but comfortable.
That's what we discussed. Most number one at this age, sir, is our comfort, financial health, but more important is our emotional health, physical health. At this moment, money comes secondary. Sir, you invest through mutual fund, because mutual fund, you can always monitor. Somebody takes care of that market volatility, no?
Yeah.
Last 2-3 days, our VIX has doubled. It was 6-7% last 3 days. I also don't know why market is falling, but all of a sudden Indian market is falling, right? And you have invested and you have within 2 days, you have lost 10%, 20%. You can sleep in peace in the night, right? Don't do that. Leave it to fund manager, sir. Thank you.
Thank you, sir. Thank you.
Sir, can I ask one question?
Any
Please go
question,
ahead,
sir?
please go
Not some question, any question.
Okay, is it good to invest in pharma? Sun Pharma and all those things are doing good, like.
Before answering your question, I just show you slide. Okay.
Okay.
You just forget India's past. It's a game-changing moment today. Today is a just game-changing moment. What has happened the last 3 years, 5 years, 10 years? Or I will tell you little. I will take a little time to answer. From independence till 1991, India became poorer and poorer. Okay, poorer and poorer, because inflation was around 8 to 10%. Bank deposit interest rate was less than that. Okay, every year, average Indian was being poorer by 1 to 2%. Till 1991, we became so poor that we didn't have money to pay foreign. We had to 3 to 5% called Hindu rate of growth. So 20 years we grew about 6% till 10 years ago, right? Or let us say till COVID. My forecast is in next 20 years, we'll growing 1 to 2% higher. So next 20 years, your stock market return is 1 to 2% higher. So if you are asking whether you should invest in stocks, answer is a big yes. But there are 7,000, 8,000 stocks, companies. Which stock we should buy? That is a question, right? So if you are a first-time investor, don't invest in stocks, invest in mutual fund. Ask your financial advisor. If you don't have, just find out an advisor, ask him, and he will guide you. Invest directly in mutual fund, which will give you maybe 0.5% less than direct investment. But a lot of the portfolio management, due diligence, like whatever we just saw, stock selection, review, rebalancing, and etc. He will do this. So answer is a big yes. If you ask me, if you 140 crores of population, if I can meet like you, ma'am, one by one, I said, have you invested? If not, tell me, give me half an hour. If you have money, tomorrow I will help you to open the account.
That's true.
Thank you.
Thank you, sir.
Other question, please. Sir, somebody asked in a chat box that the market is volatile. Should we invest now or wait for the election to be over?
Very good question again. That is why I say, invest stock. Just now I said you have to invest stock. But then when is a big question, right? You know the best, the number one investor in the world. Everybody knows the name. Warren Buffett. Don't look at timing. Time spent in stock market is more important than timing the market. So volatile means like one stock I was buying before 5 days, 100 rupees. Today it is 80 rupees. So 20 rupees less. That is a great opportunity to buy. Number one. Number two, you said very rightly election. Election is a risk. There could be till election result is out, market will be volatile. So if I am interested to invest, let us say 1 lakh rupees, what I should do? Should I wait till the election is over? Personally, I feel part of this I should invest today because the market, because of this election, there is fear. So markets have fallen 10%, 20%. So let me put some money today and keep remaining half after the result. But to answer your question, volatility means just look at the graph like Aman showed. If the market has corrected 3 to 5%, is a great opportunity to put some money today. Have I answered your question, sir?
Yeah. Again,
have I answered your question?
Sir.
Yeah, Mohit, please go ahead.
Sir, you have shown this, we should select the stock on the basis of fundamental analysis and technical analysis. Which gives the more perfection, whether fundamental analysis or technical analysis? On which basis I should do?
It depends on whether you are expert or you are beginner. If you are expert, then only you go to technical analysis and invest. If you are beginner, less experience, certainly answer is only fundamental analysis. To again give the same example, Warren Buffett, who is the probably most celebrated investor, he never goes on technical analysis. He goes to buy business. Fundamental analysis. Look at this. Go to the company, like what Oman said, Skinner.com or other money control or some other site. See last 5 years, their revenue is growing up year after year. Sales is growing, profit is growing, return on equity is growing. Then that is a stock. Out of 7,000 odd stocks, you can shortlist 5 or 10 stocks to buy. There are so many good stocks. Go to the large cap if you are a beginner, large cap stocks, and then you buy through fundamental analysis, not through technical analysis. Technical analysis is more for short term, more for day traders. And recently there is a survey study which says more than 90% traders, short term traders, they lose money. But there is excitement, okay? One
Yeah.
stock I make money, there is excitement. So buy another 10 stocks, I lose money. Till I realize, I don't realize because of that emotional, no.
Till I lose all the money.
Really foliage. And
Yeah.
because
Yeah.
because of that, so sir, to answer your question, fundamental analysis and the last 30 years, my performance as a treasury investment professional, State Bank of India 10 years and 10 years outside, 99% times my performance portfolio has done in the top quartile. Top quartile means there are 100 portfolio manager. I am comparing my performance. I will be in the top 25. And this is mostly only because of my study, research, and fundamental analysis.
Correct. I agree fully with this. Thank you, sir. Well
Thank you,
explained.
sir.
Any
Sir,
other
it is,
question?
sir, it is best to invest in SIP rather than in mutual directly.
If you have 10 lakhs today, you can invest. If you don't have 10 lakhs, but 10,000 rupees every month, you can invest SIP, systematic investment plan. And for salaried people or those people, they don't have no accumulated surplus, but they are interested to invest. So CP is the best because that is a disciplined investment, medium to long term.
Correct. Thank you, sir.
Both are fine.
Any other question?
Sir, it is best to invest in large cap, mid cap, or small cap.
Okay, very good question again, very timely. Last 1 year, mid cap and small cap have given bumper return. Somewhere 40%, 50%, depending on which stock you bought, okay? But again, investment objective is safety, liquidity, and return. If I understand, we are a group of senior citizens, right? Where safety is the number one parameter. Safety means loss of capital. We don't want. 100 rupees I am investing, I am not comfortable if I lose 5%. My portfolio falls from 100 to 95, right? So safety, liquidity, and the return, all three are addressed by large cap stocks. Why so? Because these large cap stocks, let us say TCS, L&T, or no, any other large cap stocks, top 100 stocks are monitored by so many analysts, Indian analysts, foreign analysts, global analysts, okay? So any small lapses here and there, it is caught, market, you can know because of that, corporate governance and coverage. But small cap and mid caps, well covered. So the company will be siphoning off shareholder money, not towards business or something. They will be doing something you don't know. Only you will discover, like a Satyam Computer. They were third largest Indian IT company, right? Satyam Computer. We came to know only after the fraud came to light after 1 year, 2 year, right? So please don't go for small cap or mid cap unless in you yourself as a real veteran, you have expert, you know what the stock is, I mean, company management is doing. Otherwise, go for large cap.
Thank you, sir. Thank you.
Any other question? Anybody would like to ask a question?
So there is a question in chat regarding cryptocurrency.
पढ़ के
What
सुनाइए
about
ना.
what about
What about
cryptocurrency investment? Is it safe? Hello, sir.
There is no sum up, we didn't make except for time.
Hello. Then sorry.
Okay. So I was saying, just to sum up,
Sir,
Indian growth-
excuse me,
Yeah.
could you, there was a question, could you hear the question?
yeah, okay.
No,
Sir,
there's
there
someone
was question about what about cryptocurrency investment? Is it safe?
No, I can't answer that question because I have not invested myself. In India, cryptocurrency is banned, and the fundamental analysis, as we discussed, cryptocurrency is a speculation and there is not backed by any asset. So Indian government, I think rightly they have banned, there is no cryptocurrency investment in India. So if you are investing, it is total speculative investment. I don't know to how to answer your question, but certainly safety is not there because I have some friends, those who have invested, they have asked this question many times. I say no, but they have lost heavily. Some
Yeah,
people
so
may also have made money,
quick
but they have also
bullet points if you
lost
see
it.
on crypto, quick bullet points. So it is totally unregulated. It is not regulated so far now. On tax perspective, you have to pay 30% of tax, and there's no set of losses like it is in the other investment type. There is no set of losses that you can do. That is one point. Third point is, as sir said, as sir was asked by someone that either fundamental or technical, and sir said if you are not expert, then fundamental is the only way to go. But if when you go to cryptocurrency, there is no fundamental. There are only technical what you can do because there is no there is no base for to do your fundamental analysis on. So you have to be an expert and go for this thing. Yes, we have heard a lot of stories that people earn 1,000 times of money, but they are invested in Bitcoin at 12, 11, 13. So they became millionaires out of a few $1,000s. But right now, it is very volatile. It is an expert's job to go for technical analysis and go for some crypto investment. So that would be a summarize.
To summarize, India is undergoing through tremendous positive transformation. And this positive transformation, both from economy and market. Before COVID, India was growing 10 years, 20 years before COVID, 6 to 7%. Last 3 years, it is growing 7% plus. And forecast of GDP growth next 10 years is 7% plus. It will be 7 to 8%. Equity market, last again, before COVID, if you say 15 years, 20 years, India is the fastest, highest return, around 14%, 15%. Second highest is USA, of course, in local currency. Third, looking from asset class returns, India is in a sweet spot in terms of stock market return. And the last 2-3 years, FIs, who are dominant players, they are investors, they have not invested anything. Going ahead, to me, after election, there will be another 2-3 positive factors. Monsoon coming year is again normal. FIs, those who have not invested last 3-4 years, they will come back. If they come back, again, this is good for Indian market. And third, all these digital revolution, structural stories, and a lot of things government of India has done last 5 years, structural reform, GST, or I mean that Atmanirbhar Bharat, PLI, and so many things. That capex cycle, which so last 2-3 years has been moved by government of India, now that will be picked up by private sector. So there is private capital cycle, will just starting. Banks, corporate, they are in good shape. Everybody is positive about India. If political stability, they are most likely the current government comes. Whichever government comes, if the majority is there, I am not worried about political stability because whichever government comes, the move, the flow, positive flow of information, business, market, economy is so strong. People are so hopeful. Entrepreneurial spirit is so strong. India is going to do well next 10 years. Thank you very much for this opportunity. It is a wonderful connecting with you, and I hope to reconnect with you in future also. Thank you, sir.
Thank you.
Thank you, Dr. Sengupta. Thank you, Mr. Pradhan. Thank you, everybody.
Thank you. Thank you very much, Dr. Pradhan. And thanks a lot.
Thank you.
Very ably supported by Ms. Amand, that you let us end on an optimistic note that the stock market returns will be great in the days to come, with India prospering and creating more and more GDP. Thank you very much. And thanks a lot to Mr. Paraj also. Thank you, Mr. Paraj.
Thank you, sir.
Thank you.
Thank
sir.
you. Thank you very much. Thanks, sir.
Thank you, sir.
Thank
Namaste.
you, sir. Thank you.
Thank you.